So we've heard from Bill Gross yesterday. We heard from Ray Dalio as well. What of these trades do you like out of all of them? Is this now the time to really stock up on gold and some tech, as some say, or is this more of a defensive trade ahead of the Fed?
Well, you know, we tend to think like longer term than just positioning ahead of the Fed. But frankly, when you look at what the Fed came out with in August already, I can't imagine they're going to come up with that many new policies. So there is a question about forward guidance. But the reality is we already know interest rates are not going to move for a very long time. We're going to get projections into 2023. So that might show us that rates are going to stay low up until that point. We pretty much had already a vision into 2022. So we still think that equity markets can continue to move higher, and we have some gold in our portfolios.
Esty, we're trying to sort of understand how does the Fed, I love what BMO said, how does the Fed sort of deliver and outdove themselves? My question to you for markets is, if we believe that the train has left the station and that we will get more of the same, what does that do to the spreads? You talk about high yield and investment grade spreads having almost normalized, Esty. So is there further compression to come in that trade?
I think there's potential for further compression, whether that comes now or we have a period of range trading first, I think is going to be the real question. We've seen such an impressive rebound and normalization, as you said, since March. We've already seen a big part of the move. I don't think the Fed really needs to outdove itself at this point. They've already pretty much set the stage for a number of years to come. So I think there's a number of challenges for spreads to tighten further in the next couple of weeks and months into the U.S. election. Beyond that, they will be able to continue tightening further.